harping on. Okay, so I'm just going to start off by summarizing my thoughts on SPY and whatever. We've done incredibly well with our challenges, and I really sorry guys, I really just don't want to I want to give you my thought process at the moment. So you can see the futures are down 0.9% here at the moment. Okay, so just one thing to always remember is that when a low is made, okay, it doesn't happen all the time, but usually you get a retest at a low at some stage. And that's what I was saying the other day when the rally occurred. I think it was 2 days ago. I was saying, even with or yesterday, that there's a possibility we're going to have a retest, and we never kind of took the 200-day moving average back over again. So I think this low is going to get a retest. And if that doesn't hold, I think we're probably down at 6,400 type level, okay? So that's just technical analysis. And if you look at here, just in terms of trend analysis then, if we join the tops here, you can see here, clearly we're still in a downtrend, even with yesterday's rally. So even if we got a rally above the 200-day moving average today, for example, actually, we're still in a short-term downtrend. So what I mean by that is the highs are getting lower all the time, and so are the lows. And until that changes and we break outside of that trend, I think it's unwise to jump in at this stage, especially because we're going to the end of April next with our next trade. Okay, and let's have a quick kind of a recap of where we're at. Markets on Monday morning. I was watching the markets early, and I'll be straight up with you. I put out a message to you guys saying that whilst we're good on the trade, we're not going to mess around with it. If it gets to 6,300, we're rolling out and down. And I want to share with you why I was saying that. I was watching bond yields, and bond yields, this is Monday's trading here. They spiked up nearly to 4.5%. Now, that doesn't look like a big move, right? It's significant. And the reason it's significant is that at the moment, there is, in private credit, there's stresses in the market for banks that have financed some of the AI startups, right? They're into them for big loans. And obviously, their share prices aren't doing well, and they're struggling to finance again. And some of those loans are going bad. So that's a stress in the private credit markets. It's not systemic or anything like that, but it can get systemic if interest rates keep rising. So that's one thing you've got to be aware of. Rising bond yields are not good for stocks for a number of factors, and I'll just give you a quick reminder why. Number one, just think about it from a borrowing perspective, from a consumer or from a business. They have to borrow at higher costs, okay? Number two, valuation of equities, discounted cash flows. So a lot of stocks and analysts value companies based on 5-year discounted cash flows. And what they do is they forecast out sales and costs out for 5 years, and they get to a profit number, and then they discount that back to today's value. So obviously, if the interest rates are going up, the discount factor is getting higher, which means the present value of the stock is lower. So that's another reason why. And then third, from an investment perspective, if you're an investor, right, and you've done well in the market, you might cash in your chips and go, do you know what? I can put my money into a US bond and get 4.5 to 5%. Let's say that goes to 5%. Why would I take the risk in the stock market when I can get a risk-free return of 5%? So there's 3 reasons why rising bond yields aren't good for stocks. And that's what I was watching on Monday morning. Of course, President Trump on the Saturday had said he was going to obliterate the oil fields of Iran if within 48 hours or something like that. And then I actually went for a cup of coffee and I came back and we were out of trade. And it was as quick as that because of the announcement. So the lesson from that for you guys and for me is that how news-driven this market is at this minute in time, right? So what is the current setup? Well, the market is kind of marking time right now because, you know, President Trump is saying we're talking with Iran. Iran publicly are saying we're not talking. There's messages being sent to us through third parties. That's kind of the narrative at the minute. Now, all of a sudden, Iran's kind of demands are coming through. They want a toll tax, basically, in the Strait of Hormuz and other bits and pieces. So right now, there's no formal negotiations going on, at least publicly. I'm sure there's stuff going on in the background. But my fear is that there's still ground troops on the way over to the battle zone. And my fear is this, that if push comes to shove, will there be boots on the ground? I don't think Donald Trump wants that to happen. I don't think it'll be good for him for the midterm elections. But it's a possibility. I'm not saying it's a probability. I'd say he'll try and avoid that at all costs, but it's a possibility. Because if for example, they fail with boots on the ground, they can open the Straits of Hormuz. Well, then he's probably going to give that a green light. And I will be concerned about that because I think it just prolongs the conflict. And as a result, I think you could actually even have higher oil prices. Now, this is best guess stuff. It's all conjecture. But where I'm getting at, and the point I'm trying to make is, I don't think anybody listening to this now or across the world has a foggiest notion of what's going to happen in the next 2 days. So my point is, we're in no rush to jump into a trade. And so far, we've been right. We talked about the lows getting a revisit. They're getting a revisit. It looks like they're going to get a revisit today. Here's SPY in pre-market. This little orange line, you might be able to see it. It's going to open up down here. So wipe out all of yesterday's gains and back down to the previous day's lows, basically. That's where it looks like it's going to open up. And I think you got to exercise patience. You have a technical picture here that is starting to deteriorate. We've got an unknown happening. So let me paint a positive picture. Let's say, do you know what? On Friday, there's an agreement. Everybody's shaking hands. The market might pop up. So what? Okay, you might go, oh, we should have been in a trade. But right now, nobody has a clue what's going to go on. And I'd rather get that certainty first and then be able to trade after that fact rather than basically rolling the dice, which is what I think we would be doing. So I would rather wait until next week because I'm concerned about this 5-day. Why 5 days, for example? What's the big thing of 5 days? So if you think about it, the announcement was made on Monday. 5 days gets you to the close of markets on Friday night. And that really concerns me, that time frame. It's a bit strange. And then we have the troops landing tomorrow as well. So it's all kind of tying up. I wonder, are we getting to, you know what, let's negotiate or else it's going to be a ground invasion. And I'm just concerned about that. Again, I don't think it's a probability. I think it's a possibility. And because it's a possibility, I want to stay out of the market. So I just wanted to make myself clear as to why I'm being conservative at the moment. Because I think if there's a ground invasion, you could get 4 to 5% wiped off the market in a heartbeat. We could be down in the low 600s. And I just want to show you the premiums we're getting right now for people who are into the US 500 trade. Like we roughly have to get about 32 per point here to get to our 2.5% profit. Okay, look, we're down at the 60. That's the 1st of April. I want the 30th of April. We're down here at I think it was the 5,700 I was looking at yesterday. It's not quite there. It's in and around the 5,700. What I'm saying is, if that market drops, let's say to 620, actually, we'll be able to probably write something in the low 5,000s. And I'm going to explain now why that's important to me. Okay. So if you look at the definitions of a sell-off and a bear market is defined as a sell-off of greater than 20%. So if I go to the peak of the market up here and I bring it down to 20%, that's getting us down at about 5,500 here. Okay. Now we're writing something down here like a 5,200. We've priced in with our trade kind of a considerable bear market, and we're on the right side of the trade, in my opinion. And that's why I'm waiting. I'm hoping there's a bit of a further shakeout in the market because if there is, I think it'll create a great opportunity, and that's why I'm waiting till next week. So, guys, I've spoken rambled on there for a bit there. So, if you have any input or questions on the S&P or perspectives, please jump in there now.
Yeah, Stephen, I was reading reports that apparently oil prices are going to continue to remain elevated for pretty much all this year. All refineries and energy infrastructure has been demolished quite a bit. And, it's not easy to just get them firing up again, with a lot of costs. What are your thoughts on this? Because elevated oil prices, if it stays for that long, I think we can definitely see a bear market or some sort of a recession.
It's a great question, Nanik. So I'm looking at the crude oil futures price here. You can see it's kind of hovering. It's kind of being stubborn here. And you're right. I listened to an energy expert yesterday, and they said some of the infrastructure damage now, they reckon, so first of all, the Strait of Hormuz, that could take 2 to 3 weeks to open up for mine clearing and everything else that goes with that. Then you're talking there's infrastructure that's severely damaged and broken. That some infrastructure could take up to 3 years to rebuild, they reckon. So you could be correct. Okay. Now, having said all of that, Monique, futures prices and oil prices, they're extremely volatile, right? And my view would be that if there is an agreement, let's say Iran and the US, we're sitting down tomorrow having a chat, I think you could see oil prices drop 15 to 20% on that news. But I do agree with you. I think over the medium term, we're probably going to hover near $100 a barrel for longer than we would like. And then the same expert suggested that $150 is roughly the magic number where the global economy won't be able to hack it anymore. So the result of that will be interest rate rises in the US. We already know Europe are planning to raise rates now 2 to 3 times this year because of inflationary pressures again. So all of that will be a real drag in the economy. So you're going to have a stagflationary event, which will be really, really negative. But $150 a barrel seems to be the number that's being touted around. And that's, again, why I'm really concerned about if there is boots on the ground. I don't think it will happen. But if it does happen, I wonder, will the initial reaction in the energy markets be straight up? And then I think that will cause forced selling in stocks. And all you got to do is take a little lead here as well from gold. Look at gold selling off. You would think gold would be going up in this environment. It's going down for several reasons. A, the dollar getting stronger. So that's an issue as such, right? Because don't forget, gold is priced in dollars, right? B, some central banks are reportedly selling their gold stockpiles, some of it. And then you have other private investors and institutions who might have gold holdings who might be coming under pressure in some areas of their portfolios. So they're having to sell off to maintain positions. So kind of even the safe haven has fallen, which is very, very surprising, by the way. So if you think about it, bond yields, the US bond yields should really be coming in, not going out. Because it's a flight to safety. Normally when investors are flying to safety, the bond yield comes in because the government doesn't have to pay as much of an interest rate. But you can see it's going out because of this inflationary pressure. You would expect against that, gold should go up, fly up, because gold is an inflation hedge. But no, we have it coming the other way as well. So everything is getting sold off. And that's my fear of, I'm painting a negative picture of what potentially could happen. And I've been through it enough that if this goes the wrong way over the next week, you could see 5% off the S&P 500 in a heartbeat. I think then when that happens, then there's going to be great opportunities. So I don't want to mess around with that. And with oil, I think oil prices are probably going to remain stubbornly high, but I wouldn't bet on that either. And that's the reason I'm kind of going in a roundabout way of answering what you're saying there, Nanik. I agree with you, but I wouldn't actually bet on that either with oil, because if there is some sort of an agreement, the backside could fall out of this quickly. And I just wouldn't want to be in that trade at all. And if I did do it, it would be with bear put spreads, defined risk trades, you know.
Yeah, because as I think I said, it's mostly headline news driven. So,
Yeah.
okay, let's say even if they agree that, okay, we're stopping the war, we're not going to bomb you anymore, open the Strait of Hormuz, but the oil production is wasted at the moment, right?
Well, it's
So
stopped.
how they're going to possibly ramp up that kind of production when the infrastructure is already destroyed, right?
Correct. And there seems to be a change in narrative as well from some of those Gulf states, or some of those states around. They've kind of said, finish the job. You know, some of them are starting to change their mind. They're going, no, actually, now it's time to finish the job here. Don't lighten up yet, you know. So that's very interesting, that there's a bit of a narrative shift there too. So all of that, I think you've just got to remain in cash, I think, right now, and just let this play itself out. And if we miss a bit of a rally, so be it. It's not the end of the world, you know. I wouldn't like to. I think it's just pure gambling, to be honest, right now. The short put strategy, yes, we can get down to 5,700, but all it would take is a small little sell off, and we could be writing puts down at 5,200 or something like that, and that would be great. But if we don't get that sell off, that's fine too. Then we'll just use higher strikes. All I'm saying is that waiting a week isn't the worst thing to do at this moment in time, given the uncertainty that we have. And by the way, the market is still only off from peak to trough. It's still only down, what, 5% or something like that? A little bit more maybe. From peak to trough, it's down, what, 7%. So, I mean, it's not down that much at all, to be honest with you, given what's gone on. So, you know, as I said, like if this continues for a longer period of time, I think we're going to see the S&P below 6,000. And that's why I need to see whether these negotiations are real or not.
Great.
Just a question there on the volatility in the options. What indicator do you use on that, Stephen, in the charts? Is it RHI or RVI?
I use just look at the VIX.
Okay.
Just look at the VIX, and if you go into, so let's say we wanted to trade SPY here, for example, the option chains, look at the IV rank when you're looking at the option chain. So I'll just wait for this to load. So you can see here your IV rank here at the moment is 29. So that's actually quite low. Oh, that's, sorry, let me go out a month. So the IV rank here is 29. That's actually quite low. What that's saying here, Michael, is the current implied volatility in the market is in kind of the lower third for where it has been in the last 52 weeks. So in other words, actually, there could be more volatility. You'd normally like this to be above 50 when you're writing puts to be optimum, right? It doesn't happen all of the time. So what I tend to look at from a technical perspective is the VIX. I think it's the simplest one. And obviously when you see the VIX high like this, you know the stock market is in trouble. And it's kind of just grinding higher here again. It hasn't quite reached this peak again. But all I'm saying is if this escalates a little bit further, I think you're going to have a couple of days here with the VIX over 35. And you don't want to be in a trade when that's happening. You want to be just putting it on, if that makes sense.
Yeah, I don't have the chart open now, but what's the 200-day moving average at the moment?
On the VIX?
No, on the SPY.
You
don't have it open. So.
Yeah, the 200-day moving average is at 661.
661.
And it's going to open up at 652 today, in and around there by the looks of it.
Okay.
Yeah. So yeah. But now, having said all of that, guys, I'm going to kind of try and fast forward the clock here. I would love, personally myself, if this fell down to 6,000. A couple of things is going to happen. Your RSI down here, that will be below 30. And that, I'm just going to go through a lot of examples with you now. When that occurs with the S&P 500, it's usually time to start getting very, very interested in going very, very bullish. Now, just because it's below 30 doesn't mean you go ahead and just, pretty much buy. I want to tell you what I'm talking about. Here's an example. RSI last year went below 30. We wait for a buy signal, which is this day, the 8th of April. So we would have been buying on this big day here, right? And all you do is hold the thing then until it gets to 70, right? Now, I back tested that strategy over 50 years. And 82% of the time or 83% of the time, you were walking away with a profit if you just bought and hold. When this technical setup happens on the S&P 500. So, you know, when I was seeing this the other day, that's when I was kind of putting out a note. Oh, I'm getting excited now, guys. You know what? We might get our opportunity to buy in. And I kind of just did a little rebound. I think, personally myself, this might tick back down. If we can get it below 30 and a significant sell-off in the market, I think then that could open up opportunities to buy in and go long. But right now, we just haven't got enough of the sell-off to warrant you taking the risk, pretty much. And plus, the technical picture has deteriorated. I want to remind you that again. Bond yields are creeping higher. There's nothing good about equities at this moment in time until we get some sort of a news event that suggests that this conflict is going to be over. Okay. Looking at just some of the individual equities, the ones, again, I keep talking about Alaska Airlines. When the time is right, loving that chart right there. Again, I'm not buying it now. We need, just think of an airline. Besides labor, fuel is one of the biggest costs, right? And I don't know, Ryanair, the European version of Southwest Airlines, basically said the other day, we're not hedging our fuel at these prices. We're going to wait for it to come back down. So that's a smart thing to do, assuming the price does come down. But investors will be cagey, and they'll go, well, what if we have prolonged higher oil prices? They might end up hedging at much higher prices down the line. So that's the risk airlines take. If they get their hedging wrong, it can really hurt their profitability for the entire year and following years too, you know, because they usually hedge out about 2 years. So that's kind of, we need fuel prices to come down. When you see fuel prices come down, you're going to see airlines go through the roof, and you're probably going to see cruise lines go through the roof too. But we need oil prices to come down. So until that happens, I think you pretty much stay away. Then moving into this, I want to talk a small bit about software and AI. I've been listening and looking up at a lot of experts now. You've seen the narrative shifts that are going on. Like, people are saying there's going to, now they're talking about winners and losers in AI, and that some companies are going to lose big. I mean, they're so far behind the curve. Their version of AI is terrible. You name it. So this is really about cherry picking the ones that are winning. So I'm going to show you a couple of charts of the Magnificent Seven. I want to compare two stocks. Look at Microsoft's share price. Like, I mean, wow, that's incredible. You couldn't have thought of this when these highs were happening, that this was going to happen, that you'd have Microsoft sell off 33%. I want to show you now Google and the difference. Like, what an outperformance. And the reason why is that Google's version of AI, I said it all along when it was down here, when we originally bought into it. They've nailed it with Gemini, and they've also got other things going on, so don't get me wrong. And it's not an exact direct comparison, but Microsoft doesn't seem to be getting the same love as such anymore. And the valuations have now come equal. So I always said, out of the Magnificent Seven, Google at the time was the most undervalued out of the whole lot of them, had the lowest multiples. Now the multiples have stabilized, and these are fairly matching. So it just goes to show you very quickly, this whole AI space, it's very actually hard to predict what's going to win and what's going to lose. Everybody's starting to say this now. And for that reason, I think you're better off being broad-based. And if we get this sell-off, just stick with the S&P 500. And in that way, you're going to benefit from a broad-based recovery. You're going to have to be able to pick your stocks really, really well to see what the winners are here. I think, for me, NVIDIA is going to win. I think no matter what, let's call it the brains behind the operation, has to be there. Dell has moved on us. Like, we can't buy into Dell now. It's gone up too much. That was one that I said that infrastructure needs to be there. We talked about AMD as well. So I think the kind of the brains will do well. My thing with CRM, which is Salesforce and Oracle, was that the market is more than priced in a lot of terrible news here. And actually things won't be as bad as they seem, but there's still a risk to that, by the way. Because if you think of what the analysts are saying, they're saying the risks to the like of Oracle are they're not going to be able to get their consulting premiums in anymore, because companies will have basically AI to do the consulting for them. And therefore, Oracle, they generate an awful lot of fees by providing consultants to companies, etc., like that. So that's one of the reasons why the share price is unloved. Salesforce as well. Are their CRM systems going to be relevant in X amount of time with AI the way the pace it's going at? And I keep saying this as well. Watch this space. I think if Google get a proper CRM system integrated with their Gemini, I think it's game over for the likes of Salesforce. And they were rumored to be buying HubSpot about 2 years ago, and then they backed out of it. They decided not to do it. I wonder, with the likes of these stocks getting slaughtered, will actually Google actually come and look to take them out, or already in the process of building their own. So I'm just trying to give you my tuppence worth. Look at HubSpot now, their share price, how it's collapsed. I wonder now, is that going to be on the table for a buyout by Google? And if they do, because I'm a user of Google's business products, if they do, I think it's game over. I will never shift. I won't shift anyway, but I'm just going, it's just too good. So a lot of talking from me there, guys. So, I'd love you to jump in with questions if you've got any. Is there any trades you're thinking of? And
Stephen,
yeah.
if I can.
Yeah, go ahead, Stephen.
Sorry to jump. 286. So I had to offload to cover. I had a property purchase, so it put me under pressure, and I had to offload some of my go. I got a half decent price for it, mind you. Now it's come back down again, and I'd like to get back in again. Hold off or take a go at it. Start loading up now, because I'm itching to take a hold of it. But what are your thoughts on that? Is it a buy or no?
Right now, if you were saying to me for 5 years' time, and it's an absolute buy, Stephen. But right now, I wouldn't buy anything this week. Nothing. Zero. Just let this week pass by, and if you miss a bit on the way up, so be it. I just think everything comes down if this doesn't work out in the Middle East. So I think it will, and I'm hoping it will, but I just don't see the point in taking the risk. But it should be on your buy list. And as is like Nvidia, I think Oracle and CRM are probably more riskier trades. Alaska Airlines will be another one. If things worked out in the Middle East, I'd be onto Alaska Airlines straight away. You're going to miss a rally. I'm telling you now. If oil prices start dropping, this is going to jump 10% in a day. So what? It doesn't matter. You need that certainty before you get into it. So this would be another one traded up to 56. And walk away from it then, But so you might miss it. It might jump up to 44 by the time you get a chance to get into it. Let's say there's a deal this week. But I'm telling you now, the opposite of that is this. If that deal doesn't happen, you're coming down to $30 on this stock. So just bear that in mind. So just with Google, absolutely 100%, Stephen, I'd be a buyer of that stock, because I think the current estimates are too low. I think the revenue estimates and the earnings estimates are going to continue to climb at that company.
Okay, thank you.
And our valuation multiples, by the way, we're applying a bigger discount. So, our valuation multiples on Google are still lower than what we're using for Microsoft. So I think there's more room for multiple expansion too. So I love the stock. I'd be a buyer of it. I just wouldn't be a buyer of it this week. That's all I'm saying.
Okay, thank you.
Just on, sorry.
We'll take Michael first.
Is a ratio put or a bear put on at the moment as a protection?
I probably would avoid the ratio put, Michael, and
Yeah.
a bear put spread. You know, just be prepared to lose, because as negative and all as I've been on the meeting, I'm saying, what I am really saying is I have no idea what's going to happen in the next week. I really don't. But a bear put spread, if you've got bullish trades on, you know, putting a bear put spread on SPY mightn't be the worst thing in the world. And if you lose, so be it. You're going to gain in your other positions to offset a lot of the loss, you know. So if you were all in cash now, I wouldn't put it on. I just literally do nothing for now and just wait. And then the trade will emerge. It will show its face next week. But if you are fairly long, so if your deltas are high on your portfolio, well, then putting on a bear put spread on SPY is not a bad idea at all, Michael.
Okay.
Go ahead, Nani.
I bought two
yeah.
puts on SPY yesterday. So it was very good.
Well done, Stephen. Well done. Sorry, Nani, go ahead.
Yeah, no, I was just back to Stephen Gavin's thing that he's getting a bit itchy. I was thinking, how about dollar cost averaging down? Like maybe if you're really itching, by maybe 1%, half a percent or 1%.
Oh, 100%, yeah.
Or just 2%.
No, that's fine.
And then if it goes down more, you still have enough space to buy more. But if it rallies up, okay, you've at least caught a little bit of that upside.
Yeah, not a bad idea, Monique. Not a bad idea. So what Monique is saying here, guys, let's imagine, just to keep the numbers really easy, you had a 100K account. We always say the maximum you put in any one trade is 5%. That's your maximum on a stock when you're buying a stock. I'm talking about here. So that would be 5K into Google, right? So you might say today, okay, I'm not waiting around just in case there is good news. So you put 2K in maybe today. And then if you're wrong, what Monique is saying, let's say it falls down to here, you're not going to be happy, but what you're going to do is average in and buy another 2K down here at a cheaper price and just keep averaging your price in. So there's nothing wrong with that either, Monique. Absolutely. All I'm saying to you is, if this negotiation doesn't work out, just get prepared for that to be at 260 is all I'm saying to you.
Yeah, that makes sense.
Yeah. So like, if you're in this play for the long game, so this guy's is 3 to 5 years. Remember, so don't go in checking it every day, looking to see is it up or down. You're wasting your time. You're not going to be selling it for 3 to 5 years anyway. It could get very, very ugly if you start averaging in now. But as you say as well, Nanique, if there's a deal on Friday or Saturday, it could open up big 5-10% on Monday. And we're just guessing then at that stage. So yeah, there's nothing wrong with that as long as you do dollar cost average and you don't put it all in and you keep your position size according. This is where people make the biggest mistakes, in my opinion, buying stocks. Their position size gets too big. And you know what? They put 20 or 30% into one equity. You're asking for trouble. You really are. So, you know, if you stick to a 5% rule and then, you know, maybe invest 2% now and maybe 2% if it did fall, I don't see anything wrong with that, Nanique. Yeah, I'd be okay with that.
Hey Stephen, it's Roy here.
Hey, Roy.
How you doing? Just making a few assumptions here. Assuming that the market goes down and the RSI for SPY goes below 30 and then you get the buy signal, what's the best way to go long in the market at that stage?
The safest way is just to buy the stock itself if you can.
Okay, yeah.
Now, if you're going to use IEG, right, you could literally do something like a call option, right?
Yeah.
You would buy a call option. So just to explain how that works now. So what's right, where we at? We're at 6,600 now. So let's say we felt, right, the market's going to turn now. Let's assume we're at that point right now. So you can see here, they have the current cost at 158. So we click on the buy price this time. And our bet size here might be, I don't know, let's say you're doing 10. right? I'll just go through the numbers. So let's say the rally, you think the rally, it's going to go back up to 7,000. So you bet 10 times 157. So you could lose $1,500 on this trade if it finishes below 6,600, okay, at expiry. So that's the first thing. But if you're correct and it went up to 7,000, you're going to make 400 times 10 basically. So it'd be 400 minus your 158 multiplied by 10 is what your profit will be. So 400 minus 158 is 242. Multiplied by 10, it'd be basically 2,400 you make profit. So you'd be risking like $1,500 to make 2,400 roughly. Let's say that's if it got to 7,000. So it's not a great way because you need it to go up in order to win. I'm not a huge fan. The traditional options is probably less expensive, where you would come into something like Interactive Brokers and you could sorry, we're on SPY. I shouldn't have bothered to refresh. You might just buy like a leap on SPY and go out for a longer time. So let's say you might come out here and go to I don't know, December 2028 or January 2028, and you might buy a call. Now you'd have your deltas here, the delta 0.7, whichever that is. It's probably down somewhere here. And you would buy a call here and just let it go. Okay. So for me, I would probably encourage people just buy the stock, and you can do that here in IG as well, by the way, just to open up a share dealing account. And the great thing you can do here, you can transfer your money out of your spread betting account into a share dealing account in like 2 seconds. So let's say you felt, oh, I think SPY is going to go up. I don't fancy doing the calls. So, and I don't want to spread bet it. So I'll go into my share dealing account and just buy an ETF or an index and close it out when it rallies up enough. Does that make sense? And then you can put your money back into your spread betting account if you want.
Yeah, that's great. Thank you, Stephen.
No problem. Any other questions there, guys?
So Stephen, it's Stephen Gavin. I've just one for you, if you don't mind. It's more. It's just I want to look at the Interactive Brokers platform, if you don't mind. I'm just looking about the multipliers. I was just trying to see where some were 1,000 and some were 100. Remember that contract sizes. I'm damned if I can find where it's written. Can you just point it out to me on the screen, please?
Okay, perfect. So I'm just gonna, let's say I was doing an option chain on MES, right?
There we go. Yeah.
MES is your micro future option chain, right? So you're looking there now and you can't see any multiplier here. You're kind of going, well, what does this actually mean? One way of figuring it out, Stephen, without having to go, I'll show you where you're going to get it, by the way, in a second. But one way you could figure it out, if let's say you were looking at this and we were going to do the April trade, let's say we're going to sell the 62.50 here. You can see there your max return here, you're selling a put option is 5 times the premium. So you can see 378 divided by the premium on offer is 5 roughly. So you know that multiplier is 5. You could have assumed it from that.
That's what I've been looking at. That's how I was judging it before. But you showed me something else. But I'm sorry.
Yeah, I'll show you now. Right, this is a different way of doing it. Okay, and you're right. It should be more obvious here. But if you go into trade here, and imagine click on order ticket, and imagine this time you're actually going to trade a futures contract, right? So if you type in MES here and hit enter, now this has gone slow on me for some reason. I don't know why.
I mean, it's the market's just out there open and maybe everything's all kicking off.
No, it shouldn't be. I think it's just I don't know why this is happening. It's gone extremely slow. There we go. Oh, I shouldn't have hit refresh, but anyway. All right.
Well, I'll hang tight.
We need interlude music here now, Stephen. So I don't know why it's gone a bit slow. So I'm going to show you here, and then I'll show you another way while we're waiting here. If you actually go and just even MES futures contract size, even if you Google it, it'll be pretty much, or AI will pretty much tell you, I would imagine. So, so the MES there is straight up. The AI overview is 5 times the current S&P value. So that's
Gotcha.
pretty much telling you the multiplier there straight up. But again, let me do this. Here we go. This is refreshed. It should be a little bit quicker now. Or maybe not. It's on a go, so I don't know why. You will get it here as well, Stephen. I'll just let it do its thing. I've hit enter.
I remember seeing it there before. I saw like I saw
Yeah.
1,000 you had before on something.
So you just pretend you're doing stocks, right? So there's if I go MES, hit enter, then you're going to get a load of different ones here. That's, you see, that's a stock that's out there showing up there, so ignore that.
Right.
It's just taking a bit of time. You will see it here on the side here, and then I'll show you the one with the ES now in a second as well. So again, if I change that conversation here to ES, look at the difference in the size of the contracts.
So one was 5, and this will be 50.
50 is huge. Like 50 times 6,000 is a lot of money. It's 300 grand, like, you know. So here we go. So you're looking at we'll just click on class, and you can see 1 point equals $5 US.
Yes, that's where it was. Brilliant. Okay.
There. So you have to actually go into your futures there.
Futures. Okay. Of all places. All right. Thank you.
Yeah, it should be here. I agree with you, but it's not.
You think? I mean, yeah. I just did the numbers like you did there times the prices. So fair enough. Thank you.
No problem. So anyway, guys, the markets, the losses are coming in a bit there. Actually, it's only down 0.5% now. So I don't know if there's news out there or anything like that. But anyway, I'm not going to be placing a trade, guys, until next week at the earliest. Just to let you know. And in summary, I would encourage everybody to stay in cash. There's nothing wrong with being in cash. Absolutely nothing wrong. And fingers crossed, this is all resolved over the weekend and the market's up 3% on Monday. Happy days. Then we'll reevaluate at what strikes we're going to use. But I think going in blind, which is what you would be doing right now, you're at the mercy of other people's decisions right now. And depending on that decision, this market could go anyway. And I mean anyway. Like you're talking going down 5-10% over a period of time. And you just don't want to be on the wrong side of that. Okay. So unless you have any other questions, guys, I'm going to leave it there.
Last question, Stephen. Last one.
Yeah.
Do you see anything on XLE?
The energy ETF.
Yeah, because I'm sort of convinced that the oil prices are going to remain elevated for pretty much this year. That's just my thesis. So do you see anything we could do here with the XLE, or probably not?
If you think they're going to remain elevated, so do you think they're going to go up further from here, or just stay roughly where they are?
I'm thinking between 110 to 115.
Okay, so they're not going to go up that much further. So if I were you, I would stick with like short puts or bull put spreads. I would favor the bull put spreads and go out of the money. Allow for something to go wrong. Now I'm not going to trade that myself because, again, if there's some sort of an announcement over the weekend, we've come to an agreement. I think 20% could come off the value of oil so quickly. It might meander back up to 100 when everybody realizes this is going to take time to get sorted properly. But the initial reaction could be quite violent, and that's what I'm afraid of with oil. So I think you would be better off having what we call a defined risk strategy, which would mean you might sell something like the $54 put and buy the 50 underneath it, and then at least you know all I can lose is the difference between the strikes, which is $4 multiplied by 100, multiplied by the amount of contracts you have, and then you would take whatever credit away from that. So I would much prefer a bull put spread strategy if you are going to do it, Nanik. And you can do that in USO as well. So you don't have to use that one. You could use USO here as well, and do a bull put spread on that one.
Very good point, Stephen, because if there's a news, oil prices, you're right, it could drop rapidly. So unless we see a bit of stability in the higher levels, then that would be a good time to put on the bull put spread. That's what I think.
Yeah, I think I would just stay away from that trade for this week, and you can slap me in the head next week if oil prices jump and whatever, and that's fine. But I'm just saying there's just so many unknowns right now, and we're really at the mercy of these negotiations. The markets are at that, they really are. They're on a knife edge type thing, you know. And I just don't think there's any necessity to mess around with it, and just wait for the certainty to come, and then we can trade it accordingly. But we don't have that certainty just yet.
I agree, Stephen. That's a good point. Thanks.
No problem at all, Nanik. No problem. Okay, guys. Any other questions? I'll wrap it up. Okay. Thanks for tuning in, guys. And as per usual, if you have any questions at all, just please reach out.